Alphabet is scheduled to report quarterly financial results after the markets close on February 4th, 2025. That has investors asking if they should buy Alphabet stock before it announces earnings. I'll answer that question in this video. I'll also answer if or what investors should look out for from Alphabet in the upcoming earnings release. Key details that might be overlooked if you're just looking at the headlines reported by major media outlets. So let's get started.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So Alphabet last updated investors on October 29th with their previous quarterly results. And one of the bigger things is the Google Cloud segment. This is Alphabet's rival to Amazon's web services. This is where Google and Alphabet, its parent company, generates the revenue from artificial intelligence. So revenues from this segment increased by 35% to $11.4 billion. This is led by accelerated growth in the Google Cloud platform across AI infrastructure, generative AI solutions, and core GCP products. This is the segment that is likely to grow the fastest overall for Alphabet. And this is the segment that has the greatest implications for the stock market overall. Because if Alphabet's Google Cloud segment is growing still above 30% per quarter, that would be great news for a myriad of other companies, including NVIDIA, including AMD, including Microsoft and Amazon and Oracle and others and others and others, because this is the whole AI ecosystem that's the most popular investing trend right now. It's the most exciting investing trend. It has the most growth and the most long-term potential. And so this is the biggest thing investors should look for from Alphabet when it reports quarterly results. The CEO saying the momentum across the company is extraordinary. Their commitment to innovation as well as long-term focus and investment in AI are paying off, with customers and partners benefiting from our AI tools. That's what you like to hear. You like to hear companies, when they make big investments, to come back to you and report to you and say, our investments are working. They're working better than we thought. It's more exciting than we anticipated. Those are the type of explanations you like to hear. Now, I've seen my fair share of the opposite of this, when management teams make big investments and then they come back to investors a couple of years later or a couple of quarters later and say, look, it didn't work out because of this thing or that thing, and they start placing blame and they start making excuses on why it didn't work out. So that's the bad side. This is the good side. This is the side you like to see. Companies making investments, the investments paying off. That's what senior management team are getting paid to do. And Alphabet's team is doing a great job. Also, YouTube's total ad and subscription revenue surpassed $50 billion over the past 4 quarters. And over the past, 4 to 12 quarters, I would say 1 to 3 years, we're starting to see the benefits of streaming providers, streaming content providers. The streaming industry is doing incredibly well, as we saw from Netflix's quarterly results yesterday. Streaming content providers are starting to reach the kind of scale that generates huge profits. And it's because it's foundationally built on economies and scale. YouTube, the more people that go on YouTube to watch content, the more creators will be interested in creating content. The more creators create content, the more it will attract people to watch the content. It's a positive, virtuous cycle that just feeds on itself. And the larger it gets, the more it grows. And so that's what YouTube is benefiting from. In my opinion, YouTube, and of course I'm biased, but YouTube is the best streaming content platform. You get free access to thousands and thousands of creators that are making content tailored to your specific needs. And you can find content no matter what you're looking for, what you're interested in. You're very likely to find it on YouTube. I find content that I like to watch on YouTube more often than on any other platform, more often than on Netflix, than anything else. I find content that I like to watch on YouTube. So the potential for this segment for Alphabet growing into one of its most valuable segments is already demonstrated here in the latest quarterly update. Now, revenues overall for the company accelerated in the most recent quarter, growing from 11% to 15% year over year revenue growth. That growth in revenue, as I said, the company's built on economies and scale. It's not just one of its segments. All of Alphabet's business benefits from economies and scale. Their operating margin expanded from 28% to 32%. And I've been saying for a while, it's been impressive how Alphabet has built a business, a multi-$100 billion business out of primarily free products. I find that to be truly impressive. Giving away these things like Gmail and Google Docs and YouTube and Google Search and managing to generate hundreds of billions of dollars in revenue, it's been impressive. And not just generating hundreds of billions of dollars in revenue, but doing so very profitably, very lucratively. All right. So another key thing to look out for when Alphabet's reports quarterly update is the number of employees. I was happy to see them make big job cuts late in 2022 and early 2023. They cut thousands of jobs. And I'm not saying I'm happy because people lost their jobs. That's the sad part of it. But the other part of it is Alphabet had gotten bloated in not controlling costs and just letting their employee headcount get out of control. And I'd like, from an investor point of view, from a shareholder point of view, I do own Alphabet stock. I wanted to see them get more serious about controlling costs. And I want to see them maintain that seriousness in the upcoming quarter. I don't want them to get ahead of themselves, to get excited and to let down their guard because they've had a couple of good quarters, to just let the employee count start rising again because they had a couple of good quarters. I want them to remain disciplined on costs and not get to the point where they were, 2, 3 years ago when they had dozens of, I read reports that they had dozens of massage people working at the headquarters. Employees were getting perks that were above and beyond what are normal perks, right? They were a little too comfortable, a little too much for the employees, and that comes at the expense of shareholders. And so I like to see them continue the cost discipline at Alphabet. All right, and the final big thing to look out for from Alphabet when they report results is this line item here on the cash flow statement. It's purchases of property and equipment. And you can see that rose from $8 billion in the same quarter last year up to $13 billion in the last updated quarter. For the 9 months that ended in this previous report, they spent $38 billion in purchases of property and equipment, and that was almost double the $21 billion they spent the same time last year. This is where they account for those investments in artificial intelligence, those data centers optimized for AI, those payments to NVIDIA for their GPUs and infrastructure for AI. This is where the majority of spending is going. And contrary to what many other shareholders and many other investors are talking about, I like to see this number going up for Alphabet. So I want to see the employee count remain flat or decline, but I want to see this number increase because this number, this investing in property and equipment, Alphabet has demonstrated that they've done this very effectively and very prudently. The returns on invested capital that Alphabet has reported over the previous 2 decades or previous decade have been phenomenal. And so when you have a company that's good at investing capital, you want to see them do more of that, right? I talk a lot about that with Netflix, right? Wouldn't you want Netflix to spend more money on content? They've clearly demonstrated that they're good at making content that people like to watch. So if Netflix goes to investors and says, look, we're going to spend more money on content, you should say, good. I'm glad you found ideas to spend money on to create more content because you clearly know what you're doing. It's a similar case here. Alphabet clearly knows what they're doing in this category. So I want to see them do more of it. If they have an opportunity, if they see an opportunity that's worth investing in, I'm happy to see that. I'm happy they have opportunities because it's hard to find opportunities to invest capital, especially when you're a business of this size. All right, looking to valuation, Alphabet's trading at a forward PE of 19 and a half, which I think is incredibly cheap for a business of this stature, of this level of risk, of this level of growth prospect. I think it's a great value here at this forward PE. Why is it trading at this low of a forward PE? The primary risk to the business right now is how large language models like ChatGPT will carve into its Google search business. And those risks are why you can get Alphabet stock at this price. That's why investors are concerned, and that's why the valuation is not higher. And even if you look at my discounted cash flow model for Alphabet, I have the intrinsic value at $238 a share, current market price at 200. So again, pointing to undervaluation. Should you buy the stock before earnings or after earnings? This is one stock where I do feel the price is undervalued enough where you can buy before earnings. I think the risks are to the upside for Alphabet stock. There are risks to the downside as well, but I think the greater risk is to the upside. And so if you're interested in Alphabet stock, I think it's worthwhile to buy before earnings, or you can still do what I usually recommend and do half and half. But in this case, I would lean more towards applying your allocation before earnings.
Hey everyone, if you like watching my videos, then I've added a great complimentary product just for you. I've written a book that's available for sale now that highlights my 6-step investing framework. Even if you don't follow that investing framework, just reading it and knowing how I evaluate stocks will make it a lot more interesting and informative to watch my videos. I've added the link in the description below.